Now we will learn few other issues related to the not-for-profit accounting. First, the financial instruments. So any not-for-profit entity could receive any financial instruments or any equity securities. They can receive any stocks or other bonds. So here, if you have to record those, remember, if you can figure out the fair values of those securities, you have to record as per the fair values of those securities on the statement of financial position. Now, if there is any realized or unrealized gain or losses, realized or unrealized means, realized means you sell those securities and instruments and you record any gain or loss, or it could be you are still holding it, but because of the changes in the market values you need to record those gain or losses on those investments. So of course you will record those gain or losses on the statement of activities. Remember, these gain or losses are income or loss type of items, so you have to record those in the statement of activities, and if it's a gain it will increase your net assets, if it's a loss it will decrease your net assets. Now how you will classify it, it depends on whether the interest you are receiving from a bond or from a securities, whether the donors actually made any restrictions, the incomes from that securities will be used for a specific person. If so, then it will impact on your net assets with donor restrictions. And if you see there is no restrictions from the donors, so any type of gain or loss related to the investments, it will increase or decrease your net assets without donor restrictions. Now here derivative, right, they could also receive some options and derivatives. So here remember, not-for-profit cannot use any special hedge accounting, so they will record those. But if there is any change in those derivatives, they will also record those, but they cannot use any special hedge accounting. They will just look at the changes in the fair values and they will record it. Now here you will also see that if you receive any dividend or interest or any other investment income, it's just like the gain or losses related to those investments, and you have to look at whether there is any restrictions from the donor, and you will also record those investment related income. It could be any dividends, or it could be interest, or it could be other income, and of course those will be recorded as a change in your net assets, and depending on whether donor has any restrictions or not. Then you will also learn in this module some endowment funds. Endowment funds. So endowment funds means these are permanent assets or securities or fund that the donor said you cannot use it. So it's one type of restrictions and permanent restrictions. Before 2018 you have to categorize those with restriction donations, with temporary restriction and permanent restrictions, but now here we just call it with donor restrictions. But endowment fund means that you cannot use those funds, rather you will hold it forever, just like a perpetuity, and some sort of income, interest or any other type of income from those funds you can use it. Now here remember, those type of restrictions, whether a fund is just being held as an endowment and forever it is held, you have to check whether these restrictions are board designated restrictions, or whether these are donor restrictions, donor imposed restrictions, remember, if it's board designated restrictions. That means the restrictions are being imposed by the internal board or internal party. So it is related to your net assets without donor restrictions. So if you receive any income or interest, or the board decides to keep aside some funds, all are related to without donor restriction net assets. On the other hand, if the donor said that these funds will be held forever, or the income receiving from that fund will be used only for specific purposes, those will be under the net assets with donor restrictions. So you have to check whether these endowment funds or the restrictions are related to board designated or donor imposed. Now you will see one more topic here. This is called the underwater endowment. Underwater endowment. So when you receive any endowment fund and it is from the donors, and donors impose the restrictions that the fund will be held forever as a perpetuity, and then at certain point you see the fair value of that fund actually went down way below the amount we recorded or the original gift amount. That means what you need to do at that point, you have to disclose some information. You have to show what is the actual fair value of that endowment fund, and you have to show what was the original endowment gift, original endowment value. And you also need to show the differences or the deficiency, because the financial users will look at if the fund value really went down. For example, you have some securities or stocks for a certain company. For some reason, that company is not doing well and the stock price went down way below, or you are holding some other type of assets, for example a piece of land or building, and this is permanently held but the value actually went down. So you have to disclose those values and the informations to let the financial users know. Now you will also see one example how you will show that. So the illustration 3, you will see here that a private university that has the original gift benefit, which was 10 million, but at certain point you will see the fair value, it went down, and now the fair value of that endowment fund is 9.75 million. So you just will put it in your notes, or as you will show it as a disclosure, what was the original amount of the gift, what is the fair value, and if the fair value went down, it will be shown as a deficiency. So in illustration 3 problem, you will see the difference is just a deficiency that you need to disclose. Now let's go over some CPA practice problems on the concept when one not-for-profit entity receives a donation and they will pass it to another not-for-profit entities. Farley State University is a private not-for-profit institution which established the Farley State Foundation. So they will use this Farley State Foundation, another not-for-profit entity, to raise funds. So this foundation is an intermediary or the recipient of the donations, and ultimately the beneficiary or the donation will be used by Farley State Universities. Now here you will see some important information. Both these university and the foundations, they are financially interrelated. And you saw the concept here that there might be a couple of scenarios. The recipient entity may get the variance powers of those donations or may not, and the recipient and the beneficiary could be financially interrelated or not, and depending on that we will decide whether the receipt of that donation will be counted as a liability or a contribution revenue. If you remember from your notes, when these beneficiary and the recipient are financially interrelated, no matter the recipient is receiving the variance power or not, the recipient will record this donation as a contribution revenue. So here, during the current year, an alumnus donated some investments with a fair value of 25 million, and it is also mentioned that these earnings from the investments will be used to fund scholarships at Farley State University. So if you remember that for any non-cash or physical assets, you have to record those donations as per the fair value. And here, these beneficiary and recipients are financially interrelated. So what we will do, we will debit investment, and it's at the fair value which is given 25 million, and we will credit contribution revenue, and this is for the recipient journal entry. And here you can add contribution revenue, and since the donor said that the fund will be used on the income from the fund will be used for scholarships, so you can classify it contribution revenue with donor restrictions. Now, on the other hand, the ultimate recipient or the beneficiary of this donation, which is the Farley State University, will also record a journal entry. And if you remember from the note or the chart that we just discussed in the previous video, when they are financially interrelated, the beneficiary could not see this type of donation just as a mere contribution, receivables, or contribution revenues. Rather, they will show it, this is the donation which is in the recipient's net assets. So they will debit interest in Farley State Foundation's net assets, and they will also credit change in interest in the recipient's net assets. So this is the journal entry that the beneficiary or the ultimate user of the donation will record. Now let's see a couple other problems. Question number 1. So here it says Marble Foundation, a not-for-profit organization, and they are also financially interrelated with its beneficiary organization, Boulder University. Receipts of the Marble Foundations would be displayed or disclosed in the Boulder University financial statements as what? So remember, they both are financially interrelated. So the ultimate recipient or the beneficiary will show any type of receipts of those donations as a change in the recipient's their interest in the recipient's net assets. Just like here, the beneficiary showed the changes in their interest in the recipient's net assets. So of course, Boulder University, the beneficiary or the ultimate recipient will show it as a change in the university's interest in the foundation's net assets, and they will show it on the statement of activities. So it's not just a simple note disclosure, it's not anything about equity transactions, and they cannot show it, it's a contribution, regular type of contribution revenues and contribution receivables. Now, question number 3. RAG Coalition, a non-governmental not-for-profit profit organizations received a gift of treasury bills. The cost was $20,000, additional $500 for brokerage fees that were paid by the donor prior to the transfer of the treasury bill. Now, the treasury bill had a fair value of $15,000 at the time of the transfer. At what amount should RAG report the treasury bills in the statement of financial position? So you know all type of securities, investments, any type of non-cash assets that will be recorded as part of fair value. And here the donor already paid the brokerage fees, and doesn't matter now what was the cost for the donors when they purchased those treasury bills. What matters here? The fair value. So RAG will record as per the fair values of the treasury bills, which is $15,000. So the answer is A. Now, problem number 3. RST charities received equity securities that valued at $100,000 as a gift without donor restrictions at the beginning of the year. During that year, RST also received $5,000 dividends from those securities, and those securities had a fair market value of $110,000. So, by what amount did these transactions increase RST's net assets? Well, this problem is not talking about any intermediary or donor recipient beneficiary situation. It's plain and simple. They are receiving an equity securities, and just like other non-cash assets, we will record it as part of fair value, and at the end of the year we will also adjust with the fair market value. So here at the end of the year, the fair market value of those securities is $110,000. So we will adjust it to the fair values, and they also received a dividend $5,000. And both will be here the net assets without donor restrictions, because donor didn't say anything there what they will do with that donation, or whether the income from the donation, which is the dividend, how they will use it. So both will make an increase in their net assets, and it will be both without donor restrictions. So the answer is $115,000.